Hello. Yeah, I guess it's all done. Perfect. So, hello students. We'll start with the paper 20A, which is about strategic performance management and business valuations. So in the last session, we have finished with the first 4 modules, that is almost 50% weightage portion has been done. And I have elaborately, while referring to the study material provided by the Institute of Cost Accountants of India, thoroughly I have displayed the entire concepts of all the chapters of all 4 modules via PPTs, which were comprising of crisp and exam friendly study material or study notes in a way can be looked at accordingly. So with that background, we will start with the business valuations as the section B from now on. And so there are 5, 6, 7, 8, 9. So 5 modules in section B, business valuation, which again is having a weightage wise 50%. So section A is 50% and section B is 50%. So that's the kind of weightage that has been given to both the sections now. Now means already prescribed by the institute. So we'll cover now onwards from today's session with the module 5, which is about fundamentals of business valuation. Sorry, I am having my coffee in between. Yeah, so module 5 is about fundamentals of business valuations. In short, I will be calling as BV for business valuations. And there are 6 chapters per se in this module, which in each session one by one I will try to cover, or as much I can cover chapter wise. If at all a particular chapter is lengthy, then maybe more than one session will be required. And in continuation to that, I will be taking the entire 6 chapters in that fashion. So module 5 is typically understanding the whole background of valuation per se, and maybe it will be more theoretical also. So I have again restricted myself to the study material only that is being provided by the institute in terms of my PowerPoint presentation at the time of this session. So let's understand how this whole valuation, business valuation is all about, and in a way let's see how the subject goes by, and I hope I will be able to do the justice to the conceptualization as such. So let's start. The first chapter is about purpose of business valuation. But before we start with the chapter per se, let's understand first the fundamentals of business valuation. What exactly this business valuation whole business is all about, and why is it required to value a particular business at all? Fine. So let's understand the value creation per se by doing valuation and what is the business purpose of doing any business valuation. So companies over a period of time create value for themselves. So companies create value when returns exceed their cost of capital. So broadly, this is how the value creation happens in a particular company. When the returns per se means the profits that are being earned out of the business operations that have been done exceeds their cost of capital. In such scenarios, the company creates a value for itself. And in that case, the primary goal of a business is therefore to maximize value for shareholders who have invested into the affairs of the company or the capital of the company. So therefore, understanding valuation is very crucial for achieving value maximization. Definition and importance of valuation. So let's understand definition and importance of valuation per se. So valuation estimates an asset's worth based on future returns, market comparisons or liquidation estimates. Now this is the definition which has been given by the Chartered Financial Analysts Institute of US, and typically in a way it's an estimation of an company's assets worth based on the future returns, market comparisons or liquidation estimates. So if at all a particular company or a business gets come to a position of liquidation, then what is the assets worth that will be generated based on the future returns of a particular organization or a company. So that's what it means. Just a second. Yeah. So that's the definition of valuation per se, which is about estimation of the assets worth based on the future returns, how much that asset is going to generate returns in future, or at the same time market comparisons, how the market is performing currently in terms of the business generation and the revenue generation being done by the business, or the liquidation estimate. So what if a particular business is required to be closed down, then what sort of value it will get or assets will face the value. That's what valuation is. Again, it requires judgment and data interpretations leading to varying valuations. So there are various judgmental approaches that are required to be maintained and followed also in terms of valuation. And over a period of time, it has become a expertise judgmental value for valuations as such, and lot of data crunching and data interpretation is required, thereby leading to various approaches of valuation. In a way, valuation provides an analytical basis for business transactions. So that's how the valuation per se definition and importance of valuation is. Continuing with an overview of business valuation includes estimation of the fair market value of a business at any given point in time. It requires expertise in value drivers, industry trends, competition and economic factors, and that's where the judgmental aspects comes into play. The expert judgment, opinion or views are essential to determine what are the value drivers of a particular business, what are the industry trends, what is the competition, how the competition is performing, and overall the economic factors, because normally the economic factors are always VUCA, which is volatile, uncertain, complex and ambiguous as well. So amid such business environment or economic environmental factors, Selection of appropriate valuation method and approach is very essential and critical. Yeah, Rakesh. So are you able to see the PPT and hear me also? Okay, perfect. So let's understand, because a lot of common readers of the financial statements always get confused with value creation versus profitability. So I felt, and again the institute had also commented upon what is the difference between value creation and profitability. So businesses create value by investing cash for future returns. So whatever investments or asset purchases that have been done by the business or in the business always fetch future returns, or are always the investment of cash for future returns. Therefore, there is a difference between cash inflows and investment cost adjusted for risk and time value. So short-term profit maximization is not equal to, sorry, just a second. Yeah. So short-term profit maximization is not equal to long-term value creation. And therefore companies with long-term strategies generate more value. So this is the difference between profit maximization and long-term value creation. So short-term profit maximization is not equal to long-term value creation. That's the basic difference between value creation and profitability. The key considerations in business valuation normally is that it is subjective in nature, because different valuers may derive different valuations, and therefore value is not equal to price. As Warren Buffett said, price is what you pay and value is what you get. So this is a classic guiding principle for all the finance people. Wherein the price is what you pay for buying anything and value is what you get in return of that price that you have paid. Another key consideration in business valuation is that it is always time sensitive. So valuation changes as new information emerges, and hence the time sensitivity is very critical in valuation. At what point in time a particular valuation exercise is required being done, or is being done, or is required to be done. So basis that the valuation changes, because on a real time basis lot of new information keeps on emerging. Now this new information could be in relation to the company, of course, because the business continues and it's always a going concern. But at the same time, new information emerges in terms of industry trends, in terms of the economic factors, in terms of the competitive trends also. So all these are, that's why time sensitive, and hence valuation changes as new information emerges. So therefore, let's understand the core elements of valuation. Anu, are you able to see the PPT and hear me also?
Yes, I can hear you, but I can't see your PPT.
Hello. Hello.
Now I can.
No, I am not able to hear you, Anu, but I guess Rakesh has confirmed, so you will be also able to see that. So proceeding ahead, let's see the core elements of valuation. First and foremost, business and industry understanding. So context matters beyond numbers. So under the backdrop of what sort of business a particular company or a undertaking is, at the same time what sort of industry that particular business undertaking belongs to, all these will matter in terms of valuation. So business and industry understanding sets the context for the numbers which are required to be valued, or on the basis of which valuation is done. Then comes the regulatory and legal knowledge. So compliance with various laws like SEBI, FEMA, Companies Act, and income tax also for that matter. Accordingly, the valuation will be, the core elements of valuation will be depending on the regulatory and legal requirement also. Accounting framework, so impact of evolving standards, that is Ind AS. Now Ind AS are typically Indian accounting standards. So these accounting standards have been prescribed by the Institute of Chartered Accountants of India, and that's where the law of the land has in a way authorized in the Institute of Chartered Accountants of India to decide standards for accounting. So accounting standards have been prescribed by the institute, and earlier the accounting standards used to be divergent from the global accounting standards also, like IFRS and US GAAP. But over a period of time, it has been agreed since 2016-17 that the accounting standards per se will have to be aligned with the IFRS. So International Financial Reporting Systems, which is IFRS, which is being adopted by almost 145 odd countries of the globe, and hence we decided to adopt or align our accounting standards with the IFRS, and therefore certain accounting standards were required to be revised or amended, and such amended accounting standards are called as Ind AS, that is Indian Accounting Standards, and hence therefore the valuation in a way also has to be, the accounting standard also impacts the valuation exercise as such. Fourthly, valuation methods and principles. So there are various techniques derived and created by various valuation experts also, and overall period of time it has become certain valuation methods have been accepted as an industry practice, and therefore there are the valuation methods and principles or techniques which are being adopted are also core elements of valuation. Then comes the technology. So spreadsheet and calculation skills. So strong numerical proficiency is required. So in order to be able to arrive at complex valuation or churn the complex data and create valuation out of it is a challenge itself, and hence the core element of business valuation is that it should be done by strong numerical proficient experts only. So there is a need of strong numerical proficiency in valuation, and that's one of the core element of valuation. Lastly, discounted cash flow principle. So value is equal to present value of future cash flows adjusted for risk. So every future cash flow that is going to get generated by the business will have to be discounted at a particular discount rate. So present value of future cash flows is required to be arrived at, along with adjustment for the risks, which will in a way fetch a value. That's how so these are the core elements of valuation per se: business and industry understanding, regulatory and legal knowledge, accounting framework, valuation methods and principles, spreadsheet and calculation, that is numerical proficiency, and discounted cash flow principle, which means value is equal to present value of future cash flows adjusted for the risks. So let's understand the key valuation terminologies per se, because we are understanding currently the fundamentals of business valuation. So the key valuation terminologies that often we will come across are market value. And now market value typically is the price in an arm's length transaction between knowledgeable buyers and sellers. So between the two buyers and between the buyer and seller, if at all a particular transaction happens at a particular price, and if the buyers and sellers are not related party and the transaction happening between them is at arm's length transaction, then that price which will be agreed between the such knowledgeable buyer and seller will be called as market value. Then comes the liquidation value. Now liquidation value means the sale value of assets in either orderly or forced sale scenario. So what the sale value of assets that will be fetched when it is being when the assets are being sold in a orderly or even in that case of a forced or distress sale, what we call scenarios. So irrespective whether it's a planned sale or forced sale, whatever that sale value that will be fetched by the assets, that is called as a liquidation value. Third kind of a value is the investment value. So such value is based on the individual investor's objective. So it's person specific, whatever way the investor has thought about the investment objectives, accordingly the value will be fetched or will be determined. Fourth is the fair value. So fair value is a price in an orderly market transaction at a specific date. So that will be fair value. Fifth is the fair market value. So price in an open market where neither party is under compulsion to buy or sell. In such scenario, the fair market value will be fetched. And lastly, equitable value. Now, equitable value means the price reflecting the interests of identified knowledgeable parties is the equitable. So fair market value, fair value, equitable value, investment value, liquidation value, and market value are the key valuation terminologies that one will be determining when doing a business valuation. So this was the introductory or fundamentals of per se business valuation, which is covered in the study material. So I thought I'll start with that so that the context is set right. And then we will start with the chapter 1, which is about, just a second. Yeah. So we are on for module 5, which is the fundamentals of BVs, in that purpose of business valuation. So we'll understand now the purpose of business valuation, which is the first chapter. So let's understand the importance of business. So with the backdrop of fundamentals of business valuation, which we touched upon, let's understand what is the importance of business valuation. So essential for investment decisions, which includes mergers, acquisitions, financing, and dividend policies also, and deciding dividend policies also. Now deciding dividend policy means obviously whenever the company earns distributable profits, it is the decision of the company and the management itself whether they should go for paying dividend to the respective shareholders or whether the profit should be retained in the business for business purposes only. So for all these purposes, business valuation is very essential in a way for such strategic investment decisions like mergers, acquisitions, project financing or financing per se, and dividend policies. It is required at various stages of company's life cycle, right from incorporation till liquidation of the company also. So that's where the entire life cycle of a corporate or a business, this valuation is required. So at most of this, various milestone stages of a company's life cycle, the business valuation is essential. Now let's see the application of business valuation, the common purposes. So the common purpose is for, as we saw, for where the business valuation is applied involves. So these are typical the corporate actions in normal parlance, what it is called. So these are the various corporate actions when where business valuation per se is applied. So typically, in a way, common purposes for business valuation includes fundraising, that is financing, and securities issuance. So private investors, employee stock options, right issues, sweat equity, for all these corporate actions, a business valuation is essential. Then comes public offerings. So when initial public offering, that is IPO, and stock exchange listings are involved, business valuation is applicable. In case of mergers and acquisitions, which includes leveraged buyouts also, LBOs, which are popularly called, and share transactions like, just a second. So for certain share transactions like buyback of shares, so just a second. Yeah. So, for certain key share transactions like buyback of shares, sale or purchase of business interest or controlling interest, and step-up acquisitions, the business valuation is required to be done. And lastly, restructuring and disputes resolutions also. So business structuring, example, slump sale, shareholders disputes, non-arm's length transactions, for all these purposes the valuation is essential. So these are the application of business valuation, where all the business valuation will be required. Continuing with the application of business valuation, certain legal and estate related matters, business valuation is essential, like damage claims or estate planning, succession planning, deemed disposition at death. So all these are like succession planning, wherein legal and estate matters comes up. The business valuation is essential, required to be done. Company liquidation and insolvency. So bankruptcy proceedings, if at all, are initiated against a particular business or a legal entity, or winding up proposals are being thought of for a particular entity, then in such scenario the business valuation will have to be done. And lastly, for certain accounting purposes, financial reporting purposes, compliance with accounting and financial standards, for those aspects business valuation is required to be done. So these are the application of business valuations: fundraising and securities issuance, public offerings, mergers and acquisitions, share transactions, restructuring and disputes resolution, legal and estate matters, company liquidation and insolvency, intangible asset valuation. Yeah, I missed that. So goodwill and brand valuation involves, then in that case valuation will be required. And lastly, financial reporting, wherein compliance with certain accounting and financial standards is to be done. So continue with the purpose of business valuation. While understanding the various common purposes of business valuation, there are certain regulatory frameworks also which have been prescribed for business valuation, and these regulatory frameworks are majorly covered under the Companies Act 2013, including the Insolvency and Bankruptcy Code 2016. Then certain specific business valuation requirement is there envisaged in the SEBI regulations also. So Securities and Exchange Board of India regulations mandate or requires business valuations to be done in certain instances. Third is the FEMA, that is Foreign Exchange Management Act. Under certain scenarios or certain transactions wherein foreign exchange is involved, the business valuation is required to be done. And fourth, income tax regime or income tax rules. Under income tax also, for certain gains purposes, the business valuation is required to be calculated or done. Now let's understand each and every regulatory framework, because that is very essential for any business valuer or a professional or management accountants or future management accountants like you will be doing in your career the business valuation. To know the regulatory framework is the very essential aspect of business valuation. So let's quickly run through the regulatory framework of business valuation. To begin with, the Companies Act 2013, including the insolvency, that is IBC Code 2016. So under the Companies Act 2013, Section 247 prescribes and requires that a registered valuer under the Company's Registered Valuers and Valuation Rules 2017 conduct the valuation of property, stocks, shares, debentures, securities, goodwill or any other assets as required under the Companies Act. So whenever a valuation is required to be done under the Companies Act 2013 for whatever purposes that are being prescribed and required under the Companies Act, then such valuation will be essentially done by a registered valuer, and such valuer should be registered under the Company's Registered Valuers and Valuation Rules 2017, and it is the duty of the valuer also to conduct the valuation according to these prescribed rules of the Companies Act 2013. And now let's understand where all such applicable situations may arise. One is the issuance of shares. So section 62 subsection 1 subsection C requires valuation required for preferential allotment. So whenever there is a preferential allotment, such kind of a business valuation is required to be done. Then compromise and arrangement. So section 232 and 232 mandates the valuation of shares, business or assets for certain mergers and demergers that are required to be done under the corporate restructuring. We'll have to do the valuation. Then comes the purchase of minority shareholding. So if at all there is an instance that under section 236, the shareholding held by the minority shareholders is required to be purchased, then appropriate fair compensation is required to be paid to the minority shareholders. Now how that fair compensation can be decided? For that, valuation is required. So valuation required for fair compensation to minority shareholders. Then under section 281, whenever there is a winding up of a company, then valuation of assets during liquidation is essential. Thereafter, let's see the IBC 2016 requirement regulatory framework under which the business valuation is required to be done. So under regulation 27, a resolution professional must appoint 2 registered valuers for determining the liquidation value of assets. So what is meant by liquidation value of assets? We have already seen our at the start of the session when I was taking you through the fundamentals of business valuation. So in that, liquidation value is the sale value of the assets upon forced sale or orderly sale. So now liquidation is something like forced sale. So in that case, the resolution professional under the IBC is required to appoint 2 registered values, and such registered values will be we'll have to do the valuation or appointment will have to be done in accordance to the company rules specific to the registered values as such. Then regulation 35 of the IBC code mandates the fair value and liquidation value must be determined by the registered valuer. So again, wherever there is a fair value required to be assessed or liquidation value required to be assessed, and it should be done by the registered valuers only. So this is a regulatory framework in relation to business valuation under the IBC 2016. So the prescribed regulations are IBBI into bracket insolvency resolution process for corporate persons regulation 2016. So these regulations, specifically section 20, regulation 27 and 35 makes a mention of the business valuation requirement under IBC. Then comes the SEBI regulations. So SEBI ICDR, that is issuance of capital and disclosure requirement regulations 2018. So issue of capital and disclosure requirements regulations require under regulation 166A requires a valuation report from a registered valuer for preferential allotment of shares. And then regulation 158A 158(6) sub-regulation 6 requires valuation is required for issue of shares to non-residents under the scheme of arrangement. In these 2 scenarios, the SEBI mandates valuations which are required to be done as per ICDR regulations. Then comes SEBI LODR regulations, which is the listing obligations and disclosure requirements regulation 2015. Under regulation 87, valuation report is required for restructuring proposals, demergers and mergers, etc. So wherever there are big restructuring corporate actions that are being envisaged, in that case the SEBI mandates valuation report to be conducted. Then comes the SEBI SAST, that is substantial acquisition of shares and takeovers regulation 2011. So in that regulation 8 sub-regulation 16 requires valuation by an independent valuer for indirect acquisitions. So if at all any indirect acquisitions are happening under SAST regulations, then it should be the acquisition should be valued by an independent valuer. Lastly, SEBI REITs and invitees regulations. So these are REITs means real estate investment trust, and investment trust regulations requires mandatory annual and half yearly valuation of assets by a registered valuer. So these are the SEBI regulatory framework under which business valuation is essential. Then comes the FEMA regulatory framework. So under FEMA, non-debt instrument rules 2019, earlier FEMA 20R. So rule 21 states valuation is required for the issuance, transfer or buyback of shares involving foreign investors. In such scenario, the valuation is required to be done. Then comes under this the method of valuation. So how the valuation should be done has been prescribed under the FEMA. Just a second. Yeah. So the method of valuation to be adopted under such FEMA rules are: valuation must be done as per internationally accepted pricing methodology for unlisted companies. For listed companies, it must follow SEBI pricing guidelines, and the valuation must be conducted by a SEBI registered merchant banker or a chartered accountant for unlisted entities. Another regulatory framework which has been prescribed by FEMA are the FEMA Overseas Direct Investment Regulations, in that the valuation of shares for outbound investments. So outbound investments mean a Indian company investing into a foreign geography or foreign jurisdiction, that is called as a outbound investment. Then in such case, whenever the Indian company is acquiring shares of the or investing into the shares of outside India, then valuation must be done by a category 1 merchant banker in India or an investment banker abroad. So these are the regulatory framework of business valuation under FEMA. Lastly, we will see the regulatory framework of business valuation under income tax rules. So Rule 11 UA of the Income Tax Rules 1962 specifies methods for valuation of unquoted equity shares, and that being net asset value method or discounted cash flow method. So valuation to be done by a merchant banker for discounted cash flow method or chartered accountant for the net asset value method. Then comes section 56 subsection 2 subsection Roman small 10 of Income Tax Act. So if shares are issued at a price lower than the fair market value FMV, the difference is taxable as income from other sources. And for this purpose, FMV is determined as per Rule 11 UA, which is mentioned up above. So for this purpose is section 56 to determine the gain or determine the income from other sources. If the issue price is lower than the fair market value, for such purposes, the valuation is essential to be done. Then comes section 50CA, wherein it mandates that if unquoted shares are transferred below FMV, that is fair market value, in such scenario the capital gains tax is levied based on the FMV as per Rule 11 UA. So this is the regulatory framework for business valuation as per the income tax rules. So now, again, as I said, this chapter is a very small chapter which is about purpose of business valuation. Now if you refer to the study material, students, there are certain short question and answers which have been detailed or mentioned in the study material. I have tried to create or rather bring the content out of here or the contextual study note as such from those short question and answer and long question and answer also. So begin with the sequence. The first short question and answer is about importance of understanding business and its environment in business valuation. So how important it is for understanding a business and its environment for business valuation. Let's see. So identifying value drivers. So one has to identify what are the what are the drivers or the key factors that drives the value of a particular company. So understanding key internal and external factors that influence the company's valuation. And secondly, it includes revenue streams, cost structures, market position and brand value. So all these in a way help identifying value drivers for the business. Then comes the industry competitive factors. So again, it is very important to analyze market competition, industry trends and the growth potential of the particular business. So for that purposes, it is essential for the businesses or the companies to do a SWOT analysis. So assessing the company's strengths, weakness, opportunities and threats, which are SWOT. Now what is SWOT? If you have seen my earlier sessions, which are available on YouTube or also available with the Pimpri chapter, in that the specific performance management module, that is section A, there are 4 modules as I said. In that one of the module, this SWOT analysis has been in detail covered along with the other strategic performance management tools for improvement and for measurement also. So you will have to refer to what is meant by SWOT. So in short, the what is meant by SWOT is to assess the company's own strengths, weaknesses, opportunities and threats. Now strengths and weaknesses are the internal factors which the company should be aware of, and opportunities and threats are some external factors which the company has to keep in mind and accordingly use its strengths and weaknesses to overcome the opportunities and threats also. Another dimension or importance of understanding business and its environment in business valuation are the economic and regulatory factors. So impact of macroeconomic conditions like inflation, interest rate, exchange rates, FDIs, GDP, etc. are very essential for economic and for the understanding of the business and environment, and therefore they have importance in business valuation. Secondly, one has to take into consideration the compliance with regulatory frameworks, which we just saw a while ago in previous 2-3 slides. So one has to really be aware of the compliances that are essential under the regulatory frameworks prescribed by the Companies Act, SEBI, FEMA and income tax. Knowledge of business and environment is very important. So evaluating industry cycles, technological advancements and political factors are essential to be aware of. Understanding supply chain dynamics and customer behavior also is very essential. So classic example to or the model or the strategic management model which is used is the PESLE analysis. So PESLE analysis is nothing but political, economical, S stands for social, T stands for PESLE is PESTLE. So P stands for political factors, E stands for economic factors, S stands for the social factors, T stands for technological factors, L stands for legal, so in a way regulatory factors, and E stands for environmental factors. So these are the in a way what you can say the knowledge of business environment can be gained through PESLE analysis also. So again it is very essential to understand the supply chain dynamics and the customer behavior also for coming with the appropriate business valuation. Continuing with the same, the legal and regulatory compliance, ensuring valuation aligns with the applicable laws as per Companies Act, SEBI regulations, FEMA and Income Tax Act. Preventing legal disputes and regulatory penalties, because if at all the valuation method that has been prescribed by certain regulatory frameworks, if not followed, may land up into certain legal disputes or regulatory disputes and regulatory penalties also. Understanding the accounting framework, it is very essential because interpreting financial statements accurately like profit and loss, balance sheet and cash flow is very essential, and hence there has to be understanding of the accounting framework also. Also the impact of accounting policies on the valuation is required to be recognized. Then comes the application of valuation concepts and principles. So over here the mastery of valuation approaches typically is essential. So there are 3 approaches that are normally followed. One is the income approach, market approach and asset based method. Then applying discounted cash flow method or comparable company analysis and precedent transactions will be also required. So these are the application of valuation concepts and principles. Use of calculation tools and spreadsheet application. Now here the technology comes to help. So financial modeling skills for accurate and dynamic valuation, scenario analysis and sensitivity analysis as financial models are essential for better decision making. So all in all, Understanding these all aspects, all factors ensures a realistic, compliant and market aligned business valuation that supports strategic decision making and investment planning. So I thought out of the short question and answers that have been mentioned in the study material, I will try to give you concepts overall of the whole short question and answer also. So the concept is all about importance of understanding business and its environment in business valuation. Yeah. So the next concept or the short Q&A is about what are the key factors, key elements a valuer should be knowledgeable about while doing business valuation. So let's understand that. So you will not find this in the study material per se. Study material has only a few liners for each short question, but I have tried to elaborately give you this so that you as a concept will be aware of what are the key elements of a valuer. A valuer should be knowledgeable about. What should be the skill set that a valuer should know in terms of valuation. So selection of valuation approach. So choosing the appropriate method, income, market or asset based on the business scenario is what a valuer should be aware of. Understanding when to apply DCF, when to apply CCA or when to apply the net asset value. This the valuer should be aware of. Yeah. So valuer should be doing the accurate calculation and computation. Proper execution of valuation formula and financial model is very essential, and valuer should be knowledgeable about it. Ensuring consistency in assumptions also. So accurate calculation and computation, proper execution of valuation formula and financial model should be adopted by the valuer. Then comes ensuring consistency in assumptions. So wherever business assumptions are being done or economic assumptions are being done, there should be consistency, which is a key aspect of valuation. So ensuring consistency in assumptions and projections and financial inputs. Then comes interpretation of results. So a valuer should be knowledgeable about analyzing the valuation outcome and understanding its implications. There he should be knowledgeable about identifying key drivers influencing business value and potential risks. Fourth aspect that he should be aware of is the impact on overall business valuation. So assessing how valuation findings affect investment decisions, merger acquisitions and financial reporting. At the same time, he should align valuation outcomes with business strategy and market conditions also. Another key element which the valuer should be aware of is the contextual understanding. Adapting valuation methods based on the industry, company size and regulatory compliance. Secondly, recognizing economic and sector specific influences on valuation. A well-informed valuer ensures accurate, relevant and strategic business valuation for the stakeholders. So thus, keeping all these elements in mind, the well-informed valuer will ensure accurate, relevant and strategic business valuation for the stakeholders. Then there is a short question on use of an appropriate valuation approach in business valuation, how to decide which are the factors, etc. So we'll see that as a concept now. So use of an appropriate valuation approach in business valuation. Contribution to value maximization helps businesses identify key value drivers and optimize operations for higher valuation. It guides strategic decisions like expansion, cost reduction or restructuring. Informed investment decisions. It provides investors with a clear picture of the company's financial health and growth potential. It ensures fair pricing in mergers, acquisitions and funding rounds. So these numbers are basically the references to the short question and answer which are there in the study material. So fostering business growth helps in strategic planning by assessing current value and future potential. It supports negotiations for funding, partnerships and market expansion. Improving financial health. It identifies inefficiencies, risks and areas needing improvement. Improving financial health. So in a way, appropriate valuation helps improving financial health by identifying inefficiencies, risks and areas that needs improvement. It strengthens overall the corporate governance and financial reporting transparency. So continuing with the usage, so typically these are the usage what you can say as. Just a second. So in a way I am trying to give you the concepts per se which are mentioned in the short Q&A, short questions and answers which are there, short answers what is called in the study material. I'm just cleaning up the slides also at the same time. So choosing the right valuation method, right valuation approach. So as we saw, there are three approaches. One is the income approach, which is prominently or predominantly known as DCF method. So used for businesses with predictable future cash flows. So wherever prediction of future cash flows is possible, then DCF is used, which is called as an income approach. So it's nothing to do with earnings. It's basically the how much cash will get generated in future is what is being looked at, and obviously brought at present value. Then second approach is the market approach, suitable for companies in competitive industries with comparable market data. So over here the valuation is determined based on the competition which is around and for which necessary comparable market data is available. In that scenario, market approach is followed or chosen. And third approach is the asset-based approach, wherein best for asset-heavy companies or liquidation scenarios. So wherever they are, any particular business or company is capital intensive, heavy amounts or huge amounts are involved in the assets, and in that case, asset-based approach is adopted. Using the right valuation method ensures accurate assessment, strategic growth, and long-term financial success. So then there is a Q&A or short question on the various definitions and differences of various values. So I thought I will in a tabular form, illustrate what are the various aspects in relation to valuation and how each of these type of value, which is market value, liquidation value, investment value, and fair market value, differentiates or gets defined. So definition wise, market value is nothing but open market price, which is determined by the demand and supply forces. Then liquidation value is the distressed sale price of a particular asset. Investment value is the investor specific value, whatever that investor feels is the value, then that is called as the investment value. And lastly, fair market value, which is the price determined between the willing buyer and seller, between the two parties. So it's a bipartite value, and that's why it's called as a fair market value. Subjectivity wise, market value is market driven, liquidation value is lower due to urgency because it's a distressed sale, it's being sold because of certain compulsion, so it's a forced sale and hence it will always fetch a lower value. Investment value based on the investor's perspective or perception, and fair market value is objectively determined because it's an agreement between the buyer and the seller at an agreed price. Application wise, market value is used in trading and financial reporting. Liquidation value is used in bankruptcy and forced sales. Investment value is used in mergers and acquisition because that's where the investor has a perspective or perception about the target company or the company with which it is willing to get merged. And fair market value is determined based for, or application is normally for taxation and legal compliances. Regulatory use wise, market value is used in SEBI and FEMA. Liquidation value is used in IBC 2016. Investment value is used in Companies Act and SEBI regulations. And fair market value is used in Income Tax Act and FEMA. So in snapshot, in a way, I have tried to cover the definition and differences of market value, liquidation value, investment value, and fair market value also. So short answer number 5 is in relation to rule of laws and accounting framework in business valuation. Obviously this I have elaborately covered in the earlier slides. Just to summarize in a way also, or this can be again a short note kind of a thing. Regulatory compliance ensures adherence to the Companies Act, SEBI, FEMA, IBC and income tax laws. It thereby prevents legal disputes, legal penalties, regulatory penalties and ensures transparency in valuation. Another importance of accounting accurate financial reporting is it aligns valuation with the Indian accounting standards, that is Ind AS, and GAAP, that is US GAAP. GAAP is generally accepted accounting principles for consistency. It helps in determining asset values, goodwill, intangible assets and impairment testing also. So therefore valuation in a way, or rather the role of laws and accounting framework in business valuation is very critical to give proper disclosures and transparency in the financial statements. Continue with the same, it helps understanding business value and price also. It differentiates between the market value, investment value and fair market value. So law and accounting framework in a way helps or ensures correct pricing for equity transactions and business deals. Another benefit or the role that it plays, the legal and accounting framework plays, is that it has an impact on the investment and taxations. It helps in determining capital gains tax that under the Income Tax Act and Rule 11 UA, and it guides cross-border transactions under FEMA pricing norms also. Continuing with the same, so let's understand now the role and purpose of business valuation in different stages of a company life cycle. So during the life cycle of a company, right from incorporation till liquidation or winding up or closing down, at each phase, how the valuation plays a critical role and the purpose of business valuation. Let's understand. So to begin with, the first phase normally is the startup phase when the company is just born, newly born baby. The purpose of valuation is to identify or help infusion of funds through venture capital or private equity into the business. And role of business valuation over here is to determine fair valuation for investors, negotiations and fundraising. Then the next phase comes of growth and expansion, where the business has started picking up momentum. At that juncture again, valuation is essential, and hence the during the growth and expansion stage, the purpose is to raise additional capital, issuing shares or securing loans. And the role business valuation plays is that it helps in equity dilution, debt financing and strategic planning as well. So continue with this role and purpose of business valuation in different stages of company life cycle. Mergers and acquisitions. So the purpose that business valuation satisfies is business combinations, consolidations or buyout decisions can be easily taken. Then the role BV plays is that it assesses the synergies and goodwill valuation pricing strategy also. Obviously a point comes in the life cycle of a company wherein the restructuring or financial distress may also get faced by the company during its life cycle. So during this phase, the purpose of business valuation is to be able to debt restructure, divestment or turnaround strategies, and the role BV plays that it determines the fair value of assets for reorganization. So in a way, during the entire various life cycle phases of a company, I have tried to give you the purpose and role also that business valuation plays in the whole scheme of things. And then typically the last phase in the cycle of a company is the insolvency and liquidation, if at all. The purpose of business valuation is the liquidation of assets to repay the creditors. And BV therefore establishes liquidation value under the IBC 2016. So in a way, as a conclusion, it is very essential to understand the laws and accounting frameworks, ensuring accurate, compliant and strategic business valuation, supporting decision making across all life cycle stages. Now let's understand the concept of value is not the same as price, because a lot of time value and price are confused. So what is the explanation and importance in business valuation of value and price? Let's understand. So difference between value and price. Value means the intrinsic worth of a business based on the fundamentals like cash flow, assets, growth potential. And price is the amount of buyer is willing to pay, influenced by market demand, speculation and sentiment or perception of the buyer. Warren Buffett's views are that price is what you pay and value is what you get. Now, why it is very essential to understand the difference between value and price? Let's understand that. And why it is critical in business valuation to understand that value is not the same as price. One is avoiding market speculation. So market price may be inflated or undervalued due to temporary trade. So that gets avoided in the business valuation. It ensures fair valuation, thereby helping in mergers, acquisitions and investments by assuming or assessing true worth.
Just a second. No?
Yeah, sorry. So thus it ensures fair valuation. Then in a way understanding value is not the same as price helps in better investment decision making also. So investors focus on long term value rather than short term market fluctuations, and overall it is useful for strategic business planning. It helps companies price shares, raise capital or plan expansion based on real worth. Yeah, again, understanding the difference between value and price is essential is for application in the business valuation is the intrinsic value approach DCF determines business worth based on future earnings. Market value approach uses market data but may not reflect actual business strength. And asset based approach considers tangible and intangible assets to determine a fair valuation. So to conclude, understanding the difference between value and price ensures rational investments, accurate valuation and informed decision making in the business transactions. Sorry, I am in between stopping for certain, alignments and in the PPT that is required. Because at times, because of the oversight, while preparing or in the flow of thoughts, you might miss up some hygiene in relation to the PPT presentation. Let's look at the last short answer which is there in the study material is calculation of value created for shareholders. So how the calculation is to be done? Let's understand the concept of value creation first. So value creation means the company creates value when return on capital, that is ROC, is greater than the cost of capital. So if the cost that is required to be incurred for raising capital is less than the returns or the benefits that are generated from the capital, then only there is a value creation that has happened in the company can be said. So excess return over the cost of capital generates additional value for shareholders. In a way, excess return over the cost of capital. So after covering the cost of capital, whatever excess profits remain, that typically generates additional value for the shareholders. So given data, growth rate G is equal to 20%, excess return on capital 15%, that is ROC exceeds COC by 15%. Value creation formula will be value created is equal to growth rate into excess return on capital, that is 20% into 15%. So 15% of 20% is, that is 3% of the firm's value annually is what the value creation has happened. So this is the formula of value creation. Interpretation in a way means each year the company generates an additional 3% value beyond the cost of capital. This increase of 3% enhances shareholders' wealth, stock price and long-term business sustainability. So in a way, to conclude, a company with a high growth rate and strong excess return over capital cost creates sustained value, making it attractive for investors and enhancing the financial performance. So this is how the value creation per se happens for shareholders in the overall business valuation. So in a way, over here we are concluding with the short question and answers that are given in the study material, and from those 8 short question and answers I have tried to give you the concepts per se out over here, instead of, because the answers if you see in the study material, there are hardly 3-4 liners which are there, out of which doesn't make sense how to write the answer also, or if at all that short question comes as a long question or more elaborate answer is sought for higher marks, then this is the way the answer can be written. So with that exam orientation point of view, I thought I'll give you the concepts behind those short questions and the answers that are being given in the study material. So continuing with that flow of question and answers, we'll see now the long question and answers which are given in the study material itself after the chapter 1, which is the purpose of business valuation. So long question and answer 1 is about concept of valuation and its importance in maximizing business value. So in a way, these concepts will help you to write the answers also during your examinations. If at all any descriptive questions comes up and you are required to write the answers for say 5 mark, 10 mark, 15 mark, then this could be a model answer in a way which you can write to. It just indicate you, obviously. It's my way of learning that topic and my way of answering a particular question, if at all is being asked on these concepts which are there already in the study material. So let's understand each long question and answer now. The first long question and answer is about the concept of valuation and its importance in maximizing business value. So maybe because it is about the study material only, there could be some repetitions of the concepts which I have already explained elaborately in the previous slides. But now there will be some repetitions because in a way I have covered those concepts also, but more from examination perspective, how to write an answer if at all something comes up descriptively for such questions. So concept of valuation and its importance in maximizing business value. Let's understand what is business valuation. Business valuation is a process of determining the economic worth of a business or asset. It uses different methods like income approach, DCF, market approach, CCA, or asset based approach, which is net asset value. So importance of business valuation in value maximization. Let's understand what is the importance. Informed decision making. So thereby it helps. Just a second. So CCA is comparable company analysis, or RA is relative valuation, sorry, RV, and asset based approach is the net asset value, that is NAV. Yeah, so importance of business valuation in value maximization involves or includes informed decision making, which helps in investments, mergers, acquisitions and fundraising. Second importance is to be able to have strategic planning, identifies value drivers and growth opportunities. Then regulatory compliance, wherein it aligns with the Companies Act, SEBI, FEMA and income tax laws. Yeah, FEMA and income tax laws, financial reporting and transparency. It ensures compliance with Indian accounting standards, that is Ind AS, and GAAP also, that is US GAAP. Continuing with the same, what is, sorry, again it's a repetitive slide. Yeah. So understanding the business and its environment, industry trends, competitive position, economic conditions and regulatory landscape helps in identifying risk and optimizing financial performance. Warren Buffett's famous quote is that price is what you pay, value is what you get. So value is the intrinsic worth of a business based on its fundamentals, profitability, assets, future growth, and price is the So value is the intrinsic growth, intrinsic worth, and price is the market driven amount people are willing to pay, influenced by demand, speculation and investor sentiments or perception. Why is understanding value versus price critical? One, it avoids market speculation. So thus it helps the investor focus on the real worth rather than the market fluctuations. Then it ensures fair transactions are entered into, which is very essential in or useful in M&As, investment and business sales. Supports long-term growth. Companies prioritize sustainable value creation over long-term pricing trends, or over short-term pricing trends. So to conclude, business valuation is key to maximizing value, ensuring financial stability and making informed strategic decisions with a strong focus on the intrinsic worth rather than temporary market price fluctuations. Yeah. So let's understand now the second long question and answer. Role of business valuation in an IPO, how it plays a big role in business value in the IPO. So establishing a fair IPO price, it determines the optimal share price to attract investors while maximizing capital raised. It balances company valuation and investors' demand to prevent underpricing or overpricing also. It business valuation influence sees the market conditions. So industry trends and economic climate, market sentiment, economic cycles and investor appetite impact the valuations. Competitive benchmarking, comparison with listed. Rakesh, I am seeing your login twice. So is it that you have logged in through mobile as well as through laptop or something? Hello? Okay, perfect. Okay. So that's why your name is appearing twice. That's okay, no issues. So industry trends and economic climate, market sentiment, economic cycles and investor appetite impact valuation. Competitive benchmarking like comparison with the listed peers using PE ratio, enterprise value divided by EBITDA and other financial multiples. Now let's see the regulatory and legal compliance. SEBI regulations, the company must comply with SEBI issues of capital and disclosure requirements regulation 2018, that is ICDR. Draft red herring prospectus, DRHP must disclose valuation basis. So what we are studying is the role of business valuation in an IPO, and hence therefore ICDR is very critical. Draft red herring prospectus must disclose valuation basis, risk and financial performance also. Companies Act 2013 governs corporate governance, financial disclosure and shareholders' rights. Income tax and FEMA compliances mandates pricing norms for foreign investors, tax implications on capital gains. Then the role of business valuation in an IPO involves investor confidence and transparency. So accurate valuation ensures credibility and trust in the company's growth potential. Due diligence and financial audits enhance investor confidence in reported financials. Impact on post-IPO performance. Overvaluation may lead to initial gains but long-term price correction, and fair valuation supports sustainable growth and stock price stability post-listing. So in a way, to conclude the role of business valuation in IPO, business valuation is critical in determining the IPO price, ensuring regulatory compliance and building investor confidence, ultimately impacting the company's long-term market success. Now let's look at the third long question and answer, which is about different methods to calculate the true monetary value of a business. So let's see the methodologies. So first is the income approach, which is the intrinsic value method or the DCF method. So based on future earning potential of the business, discounted cash flow method calculates the present value of projected future cash flows, best for growth oriented businesses with predictable revenue streams. Market approach. So market approach is comparative valuation method. It determines value by comparing similar businesses in the industry. So for that, comparable company analysis, that is CCA, uses financial multiples like PE ratio or EV/EBITDA. And then precedent transaction method. So analyze past M&A deals in the same sector that would have happened, and accordingly the market comparative valuation method is determining the precedent transactions method. It reflects real-time market sentiment but can be influenced by speculation. The third approach is about asset-based approach, which is the book value method. Based on the net worth of a company's tangible and intangible assets, net asset value method, total assets minus liabilities, suitable for asset heavy businesses like real estate or manufacturing. The fourth approach is the liquidation value approach. Over here it determines how much the company would get if the assets were sold off quickly. Forced liquidation value, which is the lower price and orderly liquidation value, which is like planned, in that case higher as assets are sold over a reasonable period. used in bankruptcy, insolvency, that is IBC 2016, or business shutdown scenarios. So this is how the liquidation value approach is determined. The fifth is the replacement cost approach. So it calculates how much it would cost to rebuild or replace the company's assets, includes factors like depreciation and market conditions, useful for insurance purposes or capital intensive industries. In a way to conclude the different methods to calculate the true monetary value of a business, a valuer selects the appropriate valuation method based on the nature of the business, industry conditions and financial health, ensuring an accurate and fair monetary assessment. Then the next long question and answer number 4 is to enumerate the common reasons for business valuation. Again, it's a repetition. I will just run through or read through. So raising capital and issuing shares, in that required for venture capital, private equity funding or rights issue. Example, a startup seeking series of funding. Series A funding needs valuation for determine equity dilution. IPO establishes the fair market value of shares before going public. Example, a company filing for an IPO must determine an appropriate share price under SEBI regulations. Mergers and acquisitions helps in assessing the fair purchase price and identifying synergies. Example, a tech company acquiring a smaller firm evaluates goodwill, assets and future revenue potentials. Share buyback and ESOPs, that is employee stock option plan or stock ownership plans, determines the fair price for purchasing shares or issuing employee stock options. Example, a company implementing ESOPs needs valuation for tax compliance and stock pricing. Again, business valuation is required for business restructuring and insolvency, wherein required during divestitures, spin-offs or bankruptcy proceedings. Example, under IBC 2016, an insolvent company must be valued to determine liquidation or revival strategies. And lastly, liquidation and dispute resolution needed in cases of shareholder disputes, divorce settlements or tax litigations. Example, a partner exiting a business requires valuation to determine their fair payout. And lastly, taxation and compliance norms, income tax and FEMA regulations used for capital gains tax, transfer pricing and cross-border transactions. Example, FEMA mandates valuation for foreign investments and repatriation of funds. So to conclude, the common reasons for business valuation, in a way business valuation plays a crucial role in financial decision making, legal compliance and strategic transactions, ensuring transparency and fair value assessments. Then long question and answer 5 talks about complexities involved in business valuation. So beyond a simple spreadsheet exercise, valuation is much more than just modeling. So it is beyond a simple spreadsheet exercise. It requires comprehensive understanding of financial, economic and market factors. It involves qualitative and quantitative assessments beyond just number crunching. The key complexities in business valuation involves understanding business and industry, like market trends, competition and economic conditions, regulatory and legal compliance adhering to SEBI, Companies Act, FEMA, income tax and IBC, accounting and financial analysis, knowledge of Ind AS, IFRS, GAAP and financial statement interpretation, selection of the right valuation method, choosing between income, market or asset based approach based on the business needs, and macroeconomic factors which includes inflation, interest rate, exchange rates and geopolitical risks impacting valuations. Obviously, the complexities involved includes essential skills a valuer must possess. So financial and analytical skills must be there, proficiency in financial modeling, BCF analysis and ratio analysis, regulatory knowledge is essential, understanding laws governing valuation practices. A valuer must have strategic thinking abilities also, evaluating intangible factors like brand value, goodwill and synergies. At the same time, valuer must have some amount of business acumen, that is ability to assess growth potential, risk factors and industry positioning also. And communication and interpretation of a valuer should be good, so soft skills are important, explaining valuation outcomes to stakeholders, investors and regulators. So in a way, to conclude the complexities involved in business valuation is a multifaceted process that requires expertise in finance, law, strategy, market dynamics, strategy and market dynamics, making it, and I will just like to add soft skills and market dynamics, making it far more complex than a simple spreadsheet calculations. The difference between value and price in business valuation. Let's understand that. Maybe again repetition, and hence I'll read through. Definition and core differences. Value means the intrinsic worth of a business based on the fundamentals like assets, earnings and growth potential. Price is the amount a buyer is willing to pay, influenced by market demand, investor sentiment and economic conditions. The difference of intrinsic value versus market fluctuations. Value is stable based on projected future returns, tangible and intangible assets. Price is volatile, affected by stock market trends, speculation and share market sentiment. Example, a strong company with stable earnings may have a lower market price during a downturn, but its intrinsic value remains unchanged. Logical argument for the difference. Value is determined through DCF analysis, asset-based valuation and market multiples. Price can be influenced by market hype, investor emotions and external economic shocks. Example, a startup with high growth potential value may have a low market price due to investor skepticism. Real world implications, mergers and acquisitions. Companies negotiate deals based on intrinsic value, not just stock price. Investor decisions. Smart investors like Warren Buffett focus on undervalued businesses rather than short-term price trends. And IPO pricing. Companies must balance market demand, that is price, and business fundamentals, that is value, when setting an IPO price. So as a conclusion of the difference between value and price, value is a long-term measure of a business worth, while price is short-term and market-driven. Understanding this difference is critical for accurate business valuation and informed investment decisions. Then comes the second last, I guess, or the last concept which is there in the long question and answers, which is the relationship between value maximization and business valuation also. So definition and purpose. Let's understand the difference between or relationship between value maximization and business valuation. So definition and purpose. Value maximization is the goal of enhancing shareholder wealth, profitability and competitive advantage. And business valuation is the process of determining the economic worth of a company based on the financial and market factors. Then objective alignment. So value maximization focuses on long-term growth, operational efficiency and profitability. Business valuation reflects the current worth of a company, helping stakeholders make informed decisions. Strategic decision making. So value maximization involves expansion, diversification, innovation and sustainable growth strategies. For business valuation purposes, aids in assessing if the company is undervalued or overvalued, guiding financial strategies like share buybacks or acquisitions. Market perception about value maximization is that it is a positive financial performance and strategic communication, enhances market confidence. And about business valuation, valuation multiples like PE ratio or EV divided by EBITDA reflect investor sentiment and market confidence. From long-term sustainability perspective, the relationship between value maximization is that it considers ESG factors, risk management and business resilience. Business valuation wise, higher valuation for companies with strong governance, adaptability and long-term viability. Financial management perspective, value maximization includes efficient capital allocation, cost control and financial policies drive long-term value, whereas business valuation uses financial data and projections to assess future cash flows and company's worth. In a way, to conclude about the relationship between value maximization and business valuation, value maximization is the ultimate goal, while business valuation is a quantitative measure of a company's worth. Both are interconnected with strategic decision making, financial efficiency and sustainability driving both business success and valuation accuracies. So with this, students, we come to a conclusion of the chapter 1, which is about purpose of business valuation, and we started with the fundamentals of business valuation, and then I took up the chapter 1 of the business valuation, which is the purpose of business valuation, and the whole chapter has been covered of the study material in this PowerPoint presentation. So almost 60 slides are there in this presentation, especially in a way crisply made out of the study material notes, so it can act as a notes also for examination purposes. So with this, Anu and Rakesh, since you are online, any doubts, questions or any additions that you want to make to the concept that I have taken you so far? Anu, anything? Or can we, because it's already 8:30, or can we end the
No,
session?
sir. Yes.
Yeah, Rakesh has given a thumbs up. Anu, how about you? Perfect. You have also given a thumbs up. So we'll stop for the day. See you in the next session with a new chapter, and that chapter would be, let me see what is the name of the chapter. Yeah, valuation premise. So depending on the size of the chapter, maybe a separate section will be there for valuation premise, or maybe along with some other chapter also I will be covering it up, depending on the size of the chapter that is there in the study material. So I am going with the study material. So with this, thank you for joining on the session, and see you in the next session. Signing off here. So I am closing the link now. Thank you. Bye bye. Take care. Keep studying.